Hi, it's June the 4th, 2020, episode 13, which touches on what we call balance sheet recession and some of the assets which we think will benefit and some of them which will not benefit from the current environment of a balance sheet recession. Okay. First and foremost, disclaimers. Basically, anything mentioned here in terms of performance and such of historical context, it may not be reflective of what to expect in the future. If you have any inclination to invest or you need more advice, please do approach your financial alliance advisor or even your FA advisory advisor. Okay, let's talk about the balance sheet recession, the concept of a balance sheet recession. This is something not new. The reason why I've called this revisiting the balance sheet recession is because we've brought this up with our clients in some of our meetings, some of our updates, half-yearly updates with our clients. We presented this. The reason why we've looked at it is because the balance sheet recession helps us to understand which part of the cycle we are in by looking at the balance sheet, either balance sheet of a individual, corporation, sovereign, or in aggregate, basically. Okay, so at the bottom of a cycle, you'll find that the assets and liabilities of a balance sheet are basically low. Imagine a property. If you buy a property in the depths of a recession, you're going to buy it at a very low price, and your loans are going to be very low. As economic growth picks up, your assets move faster than liabilities, i.e. your home prices move up much faster than your loans. Therefore, you get a nice premium of your price, housing price, market price, vis-a-vis what you had bought it for in the market maybe a couple months ago, a year ago, or so on. Okay. And then at the top of the cycle, you find that assets and liabilities are very high. Your asset prices don't move up very high. It's getting harder and harder for it to move higher. However, at the same time, you're taking on more and more liabilities, and therefore your liabilities catch up with your assets. You have both high assets and high liabilities. And we've seen that over the past couple of years, 1-2 years, where if you look at both the equity markets, the bond markets, the property markets, and many other markets, they were extremely high in valuation. And if you look at the liabilities, debt to GDP for sovereigns, corporate debts on their balance sheet, individual household debts, all these were very high. So basically that gave us a sense that the markets overall, in terms of where they were on the cycle itself, well, they were actually near the tail end or at the tail end of the cycle. Yeah? So what will happen is on the decline, i.e. the other side of the cycle, when a recession hits, you'll find that liabilities actually remain. They don't go away. We hope they do, but they actually don't go away. But asset prices drop much faster. So you're going to get assets dropping much faster, liabilities remain pretty high. So how do you get liabilities down? Basically, either you sell off the assets, you come up with cash from somewhere else to pay off the liabilities, or at the end of the day, the bank will do it for you by writing it off, making you a bankrupt, or forfeiting or foreclosing your property and selling it off for you, okay, to pay off your debt. So liabilities come down. And then we end up at a situation where assets and liabilities are back down to a low level. Okay, so basically today we think that we have passed the peak and we're probably in the down cycle of a recession. We're somewhere around there. So we're in a situation whereby asset prices are likely to decline and liabilities are likely to remain high. Okay. Richard Koo is an economist. He's probably the one who coined this balance sheet recession concept, based on what he understood was happening in Japan, okay, during the post-bubble period, and subsequently over the past 10-20 years after that. You may find some of his very interesting videos on YouTube. Please have a look at it, and he will explain thoroughly what this balance sheet recession is, and he speaks in very simple language, very easy to understand. But I will try and explain a little bit about what it is to you. So in Japan, what happened was in the lost decade after the 1990s, the bubble burst in about 1990, and the 1990s were a lost decade. 2000 to about 2010 were also deemed as a lost decade. Yeah, so basically about 20 years. So, but the first part or the first half of that lost decade, what happened was the Japanese authorities approached it very much like the traditional way of lowering interest rates and also fiscal spending. But what they didn't realize was that because the balance sheets of both corporations and individuals was severely impaired or severely damaged, had so much debt, it was debt laden, many of these individuals and corporations did not use whatever low interest rates, fiscal spending, and so whatsoever to actually consume more. Rather, they used it to pay off their debts. They were more worried about paying off their debts. That in turn resulted in a reduction in consumption, because consumption does not occur when you repay off your debts, and the Japanese economy continued to spiral lower and lower, and the authorities were basically scratching their head. We've actually fallen into a liquidity trap, whereby even with low interest rates, the sensitivity is inelastic. Consumers and corporations are not spending, are not buying machinery, and so on and so forth. Okay, so what happened was, in the second half of that lost decades, in the year 2000 onwards, basically the Japanese authorities adopted a new approach, whereby they came out with very innovative instruments like quantitative easing, stock buying, qualitative monetary easing, which has got to do with targeting of specific yield curve, portions of the yield curve, and negative interest rates. Okay, there is this part here where the Japanese authorities actually normalized quantitative easing. Having done so, they reversed it, very much like what the Federal Reserve had tried to do I think about 2 years ago. But that had repercussions, and I think it's now realized that in order for it to be effective, it sometimes has to carry on much longer than one has originally anticipated. Okay, and I'll touch about this in a while's time. This similarly, fiscal policy, the Japanese government had introduced very strong levels of fiscal policy, fiscal effort to try and bring out the economy from a recession. However, because fiscal discipline was still very strong, whenever they saw the economy picking up, they would actually scale back on the fiscal deficits and actually would raise taxes to try and fill the gap, or or pay off the debts they had incurred prior to that, because they had fiscal deficits. So the fiscal discipline efforts were still in place then. But what happened to the Japanese economy is, because every time they kind of reduced the fiscal deficits, they hiked tax rates, consumption tax and such, the economy fell back into a recession. So basically it was a lot of stop, start. Eventually, they realized that actually, if we really wanted to do so, the fiscal stimulus had to be continued indefinitely until both the corporations and individuals recovered. Why? Because corporations and individuals were not consuming. There's this huge gap in terms of consumption. Who's going to fill that gap? Only the Japanese government could fill that gap. Therefore, fiscal spending had to continue until both these entities recovered. And these two charts show what I've been trying to say. The private sector, as they deleverage and pay off their debt, the private sector debt to GDP actually declined, and the government had to step in to actually ramp up fiscal spending, therefore increasing government debt as a percentage of GDP to make up and try to keep the Japanese economy afloat. We're now down to assets. Which asset classes did well? Japanese bonds, JGBs, Japanese government bonds did very well. Why? Even though the Japanese government was issuing a lot of Japanese government bonds in order to pay their fiscal policy, the quantitative easing effort itself absorbed those bonds, because quantitative easing basically is a purchase of bonds from the markets. Okay, that helped to suppress yields on the Japanese government bonds, and when yields go down, bond prices go up. That's number one. And number two is, because of the deleveraging situation, many corporations were busy paying off their debts and repairing their balance sheet. Investors were also a bit afraid in terms of the default credit worthiness and default risks from the corporate sector, and a lot of them opted to buy Japanese government bonds, which is basically the risk-free rate or risk-free bond. Again, that helped in terms of demand for Japanese government bonds. Prices go up, yields come down. Okay, so basically the government bonds did well, and of course high quality bonds did well. Another thing which actually also did well was gold, denominated in yen. So gold denominated in yen in the first 10 years actually just moved sideways. It was only after the introduction of quantitative easing in Japan that gold started to rally quite strongly, from 30,000 yen per ounce in the year 2000 By the time the crisis hit in '08, it was 100,000 yen per ounce, and today it's 180,000 yen per ounce because of the debasement of the Japanese currency, continued printing of money. That actually helped the yen-denominated gold price. Assets that didn't do well, equities is one. Equities dropped 82% from top to bottom, but over a very long period, 82 years. It's 82 years, 20 years, 82%. Basically, there were rallies in between, but eventually it only bottomed out after the BOJ started to intervene directly to buy Japanese stocks via ETFs, and Abenomics came into the picture. And Abenomics is a very strong, I won't go into detail, but it's a very strong fiscal, monetary, and structural changes that took place. Okay, and you can see the Nikkei bottom up about 7,000 or 8,000 level, and thereafter rose all the way back to about 20,000 level. Okay. Another thing that didn't do well, and no surprise here, is properties, because property is a leverage instrument, and when you are in a deleveraging environment, leverage instruments just don't do well. And property prices here is a reflection of the residential prices, fell by about 44% before Abenomics kicked in between 2010 to 2015. Okay, so we saw that actually we saw that the JGBs, Japanese bonds, good quality bonds, and also gold did well during the balance sheet recession in Japan. Let's try and apply those two things to the current situation, and let's use the S&P 500. What I mean by that is, if we assume that back in the year 2000 to 2002, the S&P 500, 100% equity portfolio would have dropped 48%. If you had just put 50% of it in bonds, and we represent bonds by Barclays Global Bond Index and the gold by Hui Gold Bucks Index, okay, your losses would have been just about 15%, and if you have added some portion to gold, your losses would have just come down to about 2%. Okay, and even in a situation where equity prices came back up again to zero, recovered everything, you'll still find that the portfolio with an allocation to bond would have done pretty okay, and even better still if you had allocated to gold via the gold mining index, your gains would have been tremendous, because gold did well during that period. In the period of the global financial crisis of 2007, you'll find that a 100% equity portfolio would have dropped 57%, whereas a portfolio of 50-50 would have dropped, and 50% is bonds would have dropped about 27%, and a small allocation to gold would have still dropped about 28%. Gold didn't do that well during this particular point. Even when equity prices actually moved back up to zero, your bond allocated, if you allocate bond to a portfolio, it would have done pretty okay, 17%. If you have allocated a bit to gold, it would have been up by 11%. So still much better if you added these two elements vis-a-vis a pure 100% equity portfolio. Similarly, early this year, you would find that actually as equity fell down by about 20%, if you had some bonds inside, it would have halved your losses, lowered down the volatility. Similarly, if you had gold inside, it also would have lowered down your volatility and halved your losses. So again, this shows you that on the way down, if you have these two things in bonds and bonds and gold, it helps to lower volatility, and in fact, it helps to perk up your performance. Even on the way up here, same thing. Yeah, so basically equities come down, equities go up. If you have some gold and some bonds in your portfolio, it really does help a lot, especially if we think that we're going to what we call a balance sheet recession. So in summary, the Japanese experience is something which we really should pay attention to, because the world, I believe, is going through what we call a balance sheet adjustment, very much like how Japan went through back then. The government will step in very aggressively. There's no choice. Once you have the individuals and corporations both busy repairing their balance sheet, the government will be the one having to issue bonds in order to raise money, in order to finance the fiscal spending. Okay. Central banks, with very limited downside on interest rates, central banks will adopt very strong quantitative easing where possible. They will do that, printing money. Okay, assets that will thrive under this condition, government bonds and gold. Okay, so putting those two in measured amounts will help your portfolio reduce volatility and also give a kicker to returns. The ones that may be a bit more controversial in the sense that it may suffer downside losses, you have to be careful if it's equities, and you have to be careful if it's properties. Okay, so these two instruments, you still can have them, but they should be limited in amount, or you should actually monitor them quite closely. Okay. So okay, if you if you like the presentation on this episode, please do subscribe to our YouTube channel. Please do give a thumbs up if you like this particular video itself and all the videos that you see. I would appreciate that very much. And then I'll see you again. All the best. Thank you very much.